Welcome to the weekly update, where I'll go over the action in the market for the week of June 24th through the 28th. And then we'll see how things look for the week of July 1st through the 5th. So we're starting a new month, a new quarter, and a new week. And this last week, at least on the news front, was really quite exciting. And there's a lot happening there. I'll talk about this again in a moment, but this really doesn't seem to impact what's happening in the stock market unless it gets to deeper steps of what's actually going on. And I'll refer to that again here in a moment. Before I get started, I do post videos every day. Now, these videos are locked down right now. They're not publicly available until that day has finished. They're designed to be viewed before the market even opens or before the market closes. That's why I locked them down to go public right at the close, to give those people that are members in the program that I have the opportunity to look at them first. There's still a lot of you that find the daily videos valuable even after the market closes. So please check those out, whether you look at them when they're public or beforehand. If you want to have access to that, I'll talk about that again here in just a moment as well. I do provide daily commentary and analysis, and all the videos that I do all point to the daily video. This video, the weekly video, for me personally, it's more supplemental. I know there's a lot of people that watch this video and you have a bigger picture look through this video and a longer term horizon. But even if you're managing a long-term portfolio, my personal opinion is that you could really benefit, at least from tuning into the daily videos from time to time. I know they're longer than most. I know I don't give stock recommendations. I don't throw out a lot of opinions. I purposely, this is the way I am as an educator. I try to look at things objectively. This is the positive. This is the negative. Now we take that and we reach a conclusion, and we're pretty much indifferent when we start this whole process. And I found over over 30 years now of doing this, that has served me personally quite well, and it's what I want to also share with you. I do make a PDF available in the description below every video that I post. Some folks like to download these slides that you see, as well as all the charts, and maybe stop the video and look at the chart a little bit more in depth. That's available as a resource if you want to make use of that. I also post what are called pivot points. Now, these are good for the whole month on the daily chart. That's one chart that I post. I update it every day with the new bar or candle for that particular day. There's another set of pivot points that I also post, and those are intraday, and those do change every day. And these are really, really accurate at determining support and resistance levels within the day itself. I don't day trade. I do at most short-term positions, which means to me days to weeks. But just as I'm watching the market, I find these to be very valuable. And I'll be showing that to you again in the chart here in just a moment. I do have a private Facebook group, not really big, not really active. If you want to join and get some back and forth with me, I'm leaving this in place for now, even though I'm devoting more of my attention to the program where I have more direct contact with folks. This is another way to have direct contact with me if you don't necessarily want to join the program. I'm an educator. I want to educate you, whether you're in the program that I offer or not. If you have a problem or a question or you need clarification, that's what I do as an educator. I also really monitor YouTube and Rumble comments. I'm still having to go through on Rumble, and not as much. They must have stopped doing the webinars for the summer or something, how you can be a YouTube and Rumble social media expert. But there's still a few from time to time, and I just go through and delete those. What I want to have is an honest back and forth. I don't have a lot of comments. A lot of the real chatting back and forth that I do is within the program and even privately with members of the program. So I want to make myself available for that. But if you want to post a comment on either YouTube or Rumble, and it has to do with my analysis, you agree, you disagree, you don't like a conclusion that I reached, you do like it, fine. You know, that is what they're there for. It's not to post garbage. It's to post legitimate things. I do post videos on not only YouTube, but on Rumble. Sometimes on one platform or the other, I may have some problems uploading. Here's the link to Rumble. If you can't find me on one platform, go to the other. And that's why I post in two different places, to make it be a backup. I do have my program. It launched at the beginning of June. Now it's kind of free and open and anyone can go and look. And if you want to be a part of that, I'm going to be locking it down in July. Now it's still going to be free. I probably won't start actually charging a membership fee, which will be $97 a month, until down the road. I don't know if that's going to be in August or what. I'm just kind of rolling this out as I can. I'm a one-man operation here, and I have to do the website, and I develop all the curriculum, and I'm putting out all the courses. I'm recording them in addition to doing these videos. And I really enjoy this. This is a real kick to me, but it's slower because I'm just doing everything here by myself. There's a link to the program, the website that you can get to in the description. There's also a link on YouTube. I have a playlist that you can go through and watch. I also have some other videos that you can go through and just get an overview of what I offer there. And there are also videos over on Rumble as well. One site that I want to recommend, another YouTube channel that I think might be beneficial to you if you have a longer term approach to investing, is Schiff Capital. I have no connection with him. It's Chris Schiff. He doesn't know me. I only know him from his videos, but I watch his videos every week. He posts a video. He's a money manager where I'm an educator. Feel free to check those out if you haven't already. And there's some things that he says that I don't agree with. There are other things that he says that are kind of irrelevant to what I'm doing, but it's still valuable anyway. You can tell he's very good at what he does, and I think his videos are well worth watching. There's another channel that I would also recommend by Bob Kendall. I have no connection with him. I subscribe to his daily newsletter. It's $8 a month. He doesn't know me. He's never watched any of my videos, but he has some pretty good insight and a lot of years of experience in the markets, has some pretty interesting indicators, and he's not always positive or always negative. He tries to shoot with what's really going on right now with things. And so, again, I don't necessarily agree with everything that he says, nor is it really relevant to me, but it's out there. There's so many YouTube channels out there and Rumble channels. Somebody invests for a couple of weeks and all of a sudden they're an expert, especially if they made a little money. There's a lot of garbage, and 99.9% of all the stuff you run across is garbage. I've watched a lot of it. I'm trying to just direct you to what I consider to be the best of the best. And I have to admit, I think my videos are the best of the best. I may not have the biggest channel or the most views, but if you watch this from beginning to end and really get involved in me delivering information to you, especially as it applies to the S&P 500, I think you could find it some of the best out there. And I don't say that out of pride. I've been doing this over 30 years, and I've developed my own way of doing things that I think is a very good approach to the markets. All right, let's go back and talk about what happened. So for the week, we were down 0.08%. It goes in the books as a down week. We were virtually unchanged, though. Volume was above average. It was the end of the second quarter. Now, we've been above average lately. When you look at the daily charts, there was one day when we were below average. But other than that, volume has really been picking up. On Friday, it was the last day of the week, month, and quarter. We had some window dressing going on, a lot of maneuvering going around, and volume was just through the roof. Also, we had the Russell 2000 small cap index. It readjusts right at the end of June. That also produced a lot of volume for the small caps. We are still positive right now. Now, we're looking a little vulnerable. We're seeing a lot of negative divergences on the daily charts, and we'll see some here on the weekly charts as well. Those are a concern. When we see the S&P going up and this indicator going down, that's a negative divergence. And it doesn't always mean doom or gloom, but it's something we want to be aware of and could speak to some underlying weakness that's coming into the market. And it's about inflation and interest rates. This has been the whole scenario for the last number of years. We did get the core PCE that came out, and that's why we saw the real break higher in Friday's session. But after that ran out of steam, we spent the rest of the day declining and pretty much closed at the low for the day. We don't know if that's going to follow through into the upcoming week. We are still positive. All of the trends on the daily charts, the short, intermediate, and long term, they're still intact. There are some warning signs that are causing us some concern that we want to keep an eye on so that we're not caught off guard by anything. The first part of July is also pretty positive for the market seasonally. Now, we haven't been always sticking to seasonal patterns in 2024, so we don't know and there's a lot of uncertainty right now in the US, especially with the political situation. We don't know what's going to develop from all of that either. But there's also a lot of geopolitical events that could escalate at any time. None of those things politically necessarily have an impact on the market, but they could get to the point where they do. And so that's why I like to pay attention to those things. We are still in a strengthening trend environment, and that is positive because the green line's on top. I'll show you the chart of the ADX. The ADX is above the moving average and it continues to go up. That means the trend is getting stronger, and it's positive because the green line is up, but it has been declining lately with the down week. So for the week, here's some bullet points. The S&P declined slightly, 0.08%. You notice that I use percentage points. I don't use point values all that much. To me, it's the percentage up or down move that's most important. Now, the equal weight S&P 500, where the S&P is a weighted index, so a lot of the big Magnificent Seven, they have more of an impact on what the index does. The equal weight treats all 503 stocks that currently make up the S&P 500. They're all equal. And it was actually down 0.8%. And this is showing a real lack of broad-based participation. We're seeing some improvement, but we need to see more of a trend than just 1 or 2 days of improvements along the way. Amazon ended up climbing above 2 trillion. It's like Nvidia is already over 3 trillion, Google's, but still, my goodness. I remember when Amazon first happened and came on the scene and they went public. This was back in the late 90s, early 2000s. And the first time they actually had a profit, I mean, it was just party on, because they had been not having a profit for such a long period of time. And then when they finally showed their first profit, they went crazy. And then it just continues to go up from there. Now, there's this thing called the annual stress test, and there's some legitimate concerns about this stress test because some of these banks that failed a year ago, like Silicon Valley, I'm not a bank expert and I don't follow this all that close, but my understanding is Republic Bank, Silicon Valley, they passed the stress test that happened before they ended up flopping. So take it for what it's worth, but the bank sector and the financial stocks and the financial sector, they were up on that because they put it against the test of all these bad things that could happen. But again, is that really realistic of what could really happen? I mean, with the great financial crisis back in 2008 into 2009, they thought they had it all figured out. They thought they had all the safety measures in place. Now, this is the banks, not necessarily the Fed. And it still broke down anyway. There were things that happened that they didn't predict, that their computers weren't really allowing for. So, but for right now, this is taken as positive news. The core PCE, that's the main one. We get the whole report, but the one the market really focuses on, it came in friendly, and that's where we saw things take off, at least in Friday's open. Didn't last very long, but it did come in as friendly. And then Nike, man, they came out pretty good earnings report, but then they were looking forward. Well, we're not going to sell as many shoes, and they just dropped 20% after looking out into 2025. And there are reports of tension rising between Israel and Hezbollah. Yep, that's still happening. And the little bit that I've been able to focus on this, in fact, I'm supposed to be going to Israel this fall. I don't know if that's going to happen or not. It'll be my second trip there. And this all happened. The first trip was right before we got hit with COVID. But it's been between Israel and Gaza. And now the shift seems to be moving over where they're focusing more on Hezbollah. I've been so wrapped up in the program and developing my curriculum and recording videos, I haven't really kept up with this as much as I would like. So don't quote me on this. You may want to do a little bit more research yourself if this is an area that really impacts you. And the presidential debate, this is the political thing that I've been talking about. It really took a lot of people by surprise, whether that was planned or whether it was just complete shock. Things did not go well, at least for the Democratic side in Thursday night's debate. And this has produced some uncertainty. Now, the markets don't care. They don't care if the president is a Democrat or a Republican. They'll go up. They've got friends on both sides. And what they're more concerned about is Congress. They like to have a split Congress between Democrat and Republican, because what does Congress do? They pass laws. And a lot of those laws are regulations. And a lot of those regulations affect finance in the country. And they like it when Congress is tied down and can't really do a lot of things, which was really kind of how Congress was designed, to not really be able to do things fast. That's why we're called a republic and not just, we use democracy, but we're not a democracy. So, but this is putting some uncertainty into the whole mix. We don't know where things go from here. And I'm recording this on Saturday, June, what is it, 29th now? And it's a very fluid situation at this report. At this point, we don't know what's going to develop from here. But if it does escalate, like we're looking at a resignation or dropping out of the race or the 25th Amendment or something like that, that might have some short-term impact on the markets, because that's more of a national thing that's all happening and not really seen as positive. So, but my experience has been that these kinds of things, even if they do influence the market at all, they typically don't last for very long. Now, I could be wrong. That's why I'm really paying attention to what's going on here, because things are happening that have never happened before. So we just want to see how this plays out and keep an eye on it. Interest rates did rise. We were at 4.34% for the 10-year yield by the end of the week, where a week ago we were at 4.26%, and the dollar was also up on the week. Both of these together are putting some pressure on stocks. So for the week, the Dow was barely down 0.1%, just like the S&P was down 0.1%. The NASDAQ was up 0.2%, and most of the gains that we saw came on Friday with the Russell 2000 small caps, and we don't know if some of that had to do with the rebalancing that occurred. This is a chart that I have been showing for over a year now. This goes from 1966 to 1982, where the blue line is what inflation happened during that time. The gold line, and this, again, it's about a year old, but this is a very long-term chart. We're still in this phase where I'm circling here with the laser pointer, where inflation does appear to be dropping. Okay, that's fine. And the market's like that. And if the economy is ready for it, they would really anticipate and would be happy with a rate cut. The thing that another reason why I keep showing this chart is look what happened after that. This is when we got into the mid to late 70s. Everything shifted. It was a very difficult time in the US. I was growing up during that time, and we just skyrocketed with inflation. Now, we don't know if something like that's going to happen this time, but it could. And there's a lot of people out there. You can watch other videos online that say, yeah, it's going to happen. Everything's going to fall apart. Everything's just, get ready. It's all going to be happening. And that could play out that way. There's another side that says things are under control. I mean, it may get a little bumpy along the way, but things are going to be handled a bit different this time. And so you have both sides of an argument. And my personal interpretation is to be neutral on this. Just watch the data, watch the charts, and get our direction from the charts, not necessarily formulating some kind of an opinion about it or some kind of a forecast of what's going to happen. Just day by day, watch the charts. They tell us what will happen. Then we look at this RenMac research. They came out, and this is another chart that I've been showing for pretty much a year, I believe. When we get above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. That's why we're seeing some earnings per share forecasts. They've been coming down. Now, they've been working those forecasts in such a way so that by the time the earnings are released, it's like, oh, wow, they beat expectations. Yeah, there's manipulation and game playing going on. But that's what the market does, and that's how the market reacts. So we just kind of have to go with it instead of saying it's good or bad. Just realize it's there, and we just kind of roll with it. So we are above the 4.02% level. Just something to be aware of, and I've been showing this for a long time. Isabel Net had some blog charts. These are the earnings projections going forward. Some of these have been lowered, looking out into the future. But when you look at this from left to right, they're all going up, and that's the more important part of this. And then this says, don't give up on the bull market yet. This is, okay, we've hit the 6-month mark in 2024. So we're at the middle of the year now. We're going to start the second part of the year on Monday. When we have a return on the S&P of greater than 10%, which is what we've had, what happens going forward? Now you can look at all these numbers. Yeah, there's always exceptions. They tend to be more positive the further out you look, but over the next 3 months, we see an average return of 1.5%, the median being the 2.2%, and we're up 65.2% of the time. It gets a little better when you go out to the end of 2024, 7.7%, with the median at 9.8%, 82.6% of the time. When you go out a full year from now, so if you look at the end of June 2025, we have a 25.1% return with the median being 26.4, and we're up 100% of the time. Okay, now that's longer term. And I know the folks watching this video are longer term. If you mainly just watch the weekly video that I post, this might be a real interest to you. All right. Then looking at the U.S. heavy truck sales, we're seeing this going up a little bit, and that could be helpful for the economy. Buying big trucks, got to ship products around. When this is going down, that typically means things are getting weaker in the economy. And then looking at the weekly equity fund flows, equity as stocks, we are seeing some money coming out when we look at the 12-week moving average, but we're still positive when we look at the latest reading here as of June 26th. Then Europe is kind of in their own little political turmoil right now, specifically in France. I really haven't paid much of attention to that. It's having an impact, especially on the French market. That's the CAC 40 that trades in Paris. And it's kind of bringing the European stocks down with it. And because of that, we're seeing money outflowing from the European markets. And looking at the S&P, increasingly top heavy. Now you could look at this and come to a different conclusion and say increasing strength. This is just showing when you take the 10 largest S&P 500 companies as a percent of the total market cap, going from 1986, I don't know what that, to April of 2024. It's kind of a weird way to do the chart. It's just showing that the bigger companies are having more of an impact. So yeah, I mean, you've got the Magnificent Seven, the Fantastic Five, the Illustrious 11, you can come up with whatever you want to try to see what's going on, but it's the bigger stocks that are really driving things. And if they get hit with some pressure, that could have more of an impact on the S&P. And if they are positive, that will also have an impact on the S&P. And then what is the share of U.S. corporate profits from foreign markets? Well, we look at here with the blue line. That's from 16% when you look at this all together. From emerging markets, it's at 4%. So the rest of it, of course, comes from U.S. markets. Then as the time horizon increases, and this should be more common sense, the longer your picture look, the longer term your portfolio, the less you will see the returns being more negative. So whether it's 1 day all the way out to 10 years, and this is just declining. If you have time on your side, this will work in your favor. The markets, from my really loose calculations, going from about 1900 up till now, they're up about 70% of the time. That 30% of the time can be absolute hell, though. And that's when people can really, they panic, they use their emotions, they get out at just the wrong time. If you can ride out those waves, typically we do go up. And the longer you have with time on your side, to quote the Rolling Stones, the better it looks for you. All right, FactSet didn't have an earnings or didn't have any kind of a blog post. I think the person that writes that might be on vacation. So here's the intraday chart I was talking about. And you see these lines on here? These are the pivot points. And the cool thing about that is these pivot points are on the chart before the day even opens. And these are really significant as far as support or resistance. So we started out on Monday. We started strong and then finished rather weak. And we kind of chopped around and saw some late day strength coming in on Tuesday. We were just kind of bouncing around, but then saw a little bit of strength on Wednesday, bounced around, kind of closed lower than the open on Thursday. This is when we gapped up. We exhausted ourselves a little bit and then just spent the rest of the day coming down and closed pretty much at the low for the day. Had we been able to close near the unchanged level or having a slight gain, we would have seen different statistics for this week. So looking at the week, and these are just the 5 trading days from June 24th through the 28th, where we had 4 of the sectors being up with the NASDAQ 100, the small caps, they've been really languishing, and the S&P, where we saw the NYSE, a broad market measure, the mid caps, which have really been languishing lately, and then the Dow ended up being down on the week. Now, the other charts that I look at, they go from Friday to Friday, where I look at just the trading days. Last week I did 4 because we were closed one week. This week I did 5 from Monday through Friday. Going back to the beginning of the year, we have the NASDAQ and NASDAQ 100 doing the best. Even with the up day and up week that we saw for the small caps, they're still negative year to date. The sectors. This is looking at over the last week. And what I do, since we had a down week, I arranged these from what was down the most on the top to what was actually up on the bottom. And utilities, discretionary, which has been a frustrating area, and communication were down. Then when we switch over and we look at those areas that were up, real estate was up the most, and energy saw a nice little bounce, as well as the financial sector as well. Now this next chart, it's the same thing, but I organize it differently. I go way over to the right-hand side, and this is called a scooter score. The higher the score is, the better looking that particular sector. It's on a scale from 0 to 100. We still have the tech sector and communication sector. They're in the 90s, and they're holding up the best. Then we drop down a little bit with these other sectors. When we start to drop below 50, we look at real estate and materials, and those are the 2 areas that have been performing, that did perform the worst this past week. So looking at this more in a graphical way, where we have tech and communication and discretionary were up, all the other sectors ended up being down for the 5 trading days this past week. This is going back to the beginning of the year with tech and communication being positive. All of the other sectors are still negative. That just tells you we've been going up with the S&P. It's tech and communication that really have been leading the market higher. This is another way of looking at things. This is the relative rotation graph. And I'm going to be doing some extra classes in my program and really breaking this out, and possibly even doing an extra video. I think this is a very interesting way to study things. I use more of a generic approach with this particular chart. This goes over the last year and looks at all the different sectors. There's 11 sectors in the S&P. They're listed over here on the right-hand side. And if it's green and going down, and if we're up in this upper quadrant here, that's a plus plus. These are the stronger areas, but we can see utilities are starting to fade. Then we have energy, which was up in this area, and it's really beginning to fade. And a lot of these areas are starting to show some weakness. Where we look at the staples, they're still doing okay, but they have been showing some weakness as well in here. So I'm going to break this down and do shorter term time frames. I'll break out growth versus value and do some different things in these other videos. But these won't necessarily be public videos. These will be, you'll have access to those in the program. And then this is looking at this in chart form, where over the last year, the utilities have been the strongest, with staples and then tech. And then a little bit after that is communication. Then we start hitting these red lines, and these other sectors, I won't read them off to you, compared to the S&P have really been underperforming. This is another way of looking at this, or the weekly performance, just looking at the indexes, the major indexes. The utilities have been a stronger area, but starting to come down. That's showing some weakness. The NASDAQ 100 has been coming back up after showing some weakness. The OEX, that's the S&P 100, the bigger stocks in the S&P 500. The S&P has also been bouncing back up. We're seeing some weakness in mid caps, small caps. This is the Dow Jones Composite Average, where it takes the Dow, the trannies, and the utilities and puts them together. They're also showing some weakness in transportation, which has been a very disappointing area of the market. That's about the weakest area currently, based on this analysis. Here's a chart looking at this where utilities are still holding up well. That's not only a sector, we look at that more as an index as well. The S&P 100, the NASDAQ 100, and the S&P. These are the stronger areas of the market. All of the areas in red are now looking more negative. And I compare this to the Wilson 5000, which is a broad market index. Sentiment, we're actually ticking up. We dropped down into the fair area, then we're getting back up into the neutral area. So we're kind of looking at the neutral side of things right now. Sentiment has not been, this sentiment gauge has not been following what the S&P and NASDAQ 100 have been doing. As they've been going up, we actually saw sentiment drifting down, and that's because of the negative divergences that we're seeing in the components that are used to make up this particular index. This gives you a look at this more on a historical basis and how it has changed. Typically, when we're below 50, that's more of a negative slant, and we've been kind of drifting down overall. So on a sentiment basis, we're negative, but we're just off of recent all-time highs with a lot of the major indexes. So we're seeing a real divergence there. I'm not sure if it's a positive divergence or they're certainly not converging these days. These are the active asset managers. They did tick down just a little bit in the latest reading. When we start to see this extreme is when we get above 90. Here's a look at that same chart where we came in at 85.44, looking fairly positive right now, but not necessarily extreme. This is the VIX, and this is a weekly chart of the VIX, where we have been declining on a closing basis on the weekly chart, where that's been coming down after it had been going back up. And we look at the bar chart where we're just trailing along these very low readings in the VIX. We look at the Ulcer Index on a weekly chart. It's below its moving average and going sideways, and we pretty much are doing the same thing now on the daily chart. This is the spread between risky and not as risky bonds. When this really goes up, that means we're freaking out. You can see here back during the financial crisis. Other times when we hit some difficult times back in about 2015. This is the COVID plunge right here. Well, we continue to pretty much decline with this, so the bond market is not seeing a lot of fear as measured by this. Now, this is that same chart, but shown in a completely different way. On top is the S&P, which is coming off of recent all-time highs. In the middle area is the chart that we just saw, but flipped upside down, so it's inverted to match with what's going on with the S&P. The VIX, which we usually look at when it's going down, that's more positive for the market. I inverted that as well to kind of match all of these up with each other. And we're not necessarily seeing anything of real concern right now, other than possibly complacency in the market. The latest reading from Investors Intelligence came out on June 25th. We're above 3. And so that's more positive without being extreme positive. The RIDEX bear pull ratio, these folks just get hammered all over the place. We have an up day, they go long. We have a down day, they go short, and they're just getting whacked all over the place right now. The latest reading from the American Association of Individual Investors, they did drop down a little bit, not giving us an extreme positive reading. I also follow this 50-day moving average, and that continues to go up. We tend to roll with this. And just so you know, who are individual investors? That's me, that's you, and probably everybody who listens to this video. You're in that category. This is an actual group that you can join if you're interested in that. And then we look at kind of a reverse psychology thing here, where we compare cash and how does that perform against the tech sector. When this black line is going down, that means the tech sector is outperforming, and that's what we've been seeing pretty much since we hit the bottom back in October 2022. This has been going down, and this is longer term positive. Looking at the economy, we did get another reading of the third estimate for GDP. Since this is the third time we saw that report, it wasn't all that influential. We're coming in at about, 2.8, 2.9% for GDP based on this green line. If you follow the consensus, we're at about 2.5% to the upside and about 1.5% to the downside. This is another way of representing that. We're focusing more on this column here, way over on the right-hand side. The takeaway that I usually say from this is these are all positive, because one of the parts of being in a recession is when GDP is negative for 2 consecutive quarters, and we're still holding up there. This is updated weekly, the Chicago National Financial Conditions Index. We get nervous when we go above the black line. We're actually declining below the line right now, so not seeing an awful lot of concern here. We are going up, but this will be updated, I hope, in the next week or so. It was last updated on June 7th, but we're still below the red line. We get nervous when we cross above that red line, and we're not there yet, at least in the latest reading. This is updated where we're showing the recession probabilities. We're getting up to the black line. Again, we get nervous if we go all the way up to the red line, so not a lot of concern there. Brave Butters, this is actually a quarterly report, so it won't be updated for many months now. It was going up, which was causing some concern. Now it's coming down in the latest reading that we got at the beginning of June. Inflation now, this takes inflation for CPI and PCE and plots them every day. we are seeing a little bit of drop off in inflation here because we had the PCE report coming out in Friday's session. Fed Watch, this is what everybody's wondering. Are they going to cut or lower rates at the next meeting? Are they going to keep them the same? As of right now, on the close on June 28th, their meeting is July 31st. So we're still more than a month away from that meeting. There's an 89.7% chance that they will leave rates unchanged. That's because this is coming in at 5.25 to 5.5, and that's where rates are at right now. And we really haven't seen much of a change looking at how this is locked in, this idea that there won't be rate cuts. What the market is trying to anticipate is that there could possibly be a rate cut in September. They will meet September 18th. And right now, there's a 57.9% chance that they're going to cut rates 0.25% at that meeting. This is going to change. As we get closer and closer, they'll have to lock these things in a little stronger to see if that's even going to happen. And this shows how this has changed, and it really hasn't. This is where we're at now. A day ago, a week ago, we have locked this more in at a rate cut going back a month, but we haven't seen an awful lot of change in these probabilities. This is the Fed balance sheet, where it does still appear to be going down when you look at the longer term chart, but you look here where we actually are seeing an increase. This could be some maneuvering that the Fed is doing by actually going out and doing some buying, and the market likes that. Looking at the total assets on a year-over-year basis, where we are starting to go back up, and we have been since the latter part of April. This could be positive for the market. Even though 20 years ago, the Fed promised they would never do anything like this, now it's become an accepted procedure. But if you look over here, we actually are showing where we're still negative when we look at this on a year-over-year basis. This is the overnight reverse repurchase agreements. We are picking up just a little bit here, but for the most part, we have been declining. So we're not seeing an awful lot of fear at this point by looking at this chart. Looking at our breadth, we are still looking positive with the advanced decline line. Now, these are all weekly charts here. So this is still looking good. We're also looking pretty good when we look at this based on volume. So we're still positive with this internal measure. We did see a little bit of an expansion of the new highs, but not as much as the previous week, and really no expansion of the new lows. So our 4-week moving average is starting to go back up. Our 10-week moving average is still pretty much flat. The advanced decline ratio, this looks at a 19-week exponential moving average, that's blue, and a 39-week exponential moving average, that's red. We're above zero. Even though we chop sideways here, we're still positive. Accumulation distribution, this is a smart money indicator. We did decline with the slight down week, but we're still above an advancing moving average. This means the smart money is still buying for now. This is the trend and what I talked about earlier on. When the black line is above this moving average, which is red, that means it's a strengthening trend. When the green line is above the red line, that means it's a positive trend, even though we did tick down with the down week this past week. This is the Erin indicator. This tries to measure buyers, which is green, versus sellers, which are red. And we're getting a pretty high reading here, but that's looking quite positive. The mass index is not generating a signal. Here's our daily chart. We've pretty much been chopping sideways. It looked like we could have had a breakout on Friday, but we opened at the top and shot up really quick and then pretty much closed at the bottom. So that's not necessarily a positive thing that's happening right there, but we really have been chopping sideways. We have been above average when you look at the bottom to see that volume has been above the moving average that I plot. We're negative in the short term with the mid caps. All of the other time frames and indexes are still positive. We're negative with bonds in the short and long term. We're still positive in the intermediate term. When we look at stocks, bonds, commodities, and the dollar, they continue to be in uptrends. The decision point scorecard has not been updated, and it's positive across the board. This is a longer term chart going back to 2009. We are still well above the midpoint of the channel. If we do keep going up, I'll extend these lines to see if they end up becoming some kind of overhead resistance. This is encouraging, and I actually got this wrong in the daily video. We closed at 54.60 in Friday's session. This R2 level is 54.51. I said we were 19 points above it. We're 9 points above it. So I apologize for that mistake. The fact now that for 2 weeks we've been above this R2 level is positive for the time being. Just to show you how important these points are, after the COVID plunge and we were really going up and we went into the end of 2021, we hit one of these pivot points and that was the top, and then we went down. Then we started to bounce back up. And then about a year ago, we hit another one of these pivot points and then started to go down. Now we've been going up. We got above R1, danced around that for a little while. Now we're starting to deal with R2. And these pivot points are good for the whole quarter. So we're probably going to be getting some new ones calculating as we go into July. When we look at just a moving average based on 50 weeks and compare it with price, both the red line and price continue to go up. The long-term trend, this uses a moving average crossover, a 13-week, that's the slower blue line, and a 50-week, and this is still continuing to show the long-term trend is up. We're seeing a little bit of things that are concerning us. We're still negative on the daily charts with the S&P McClellan oscillator. We're also dropping below zero here with the weekly chart. This is showing a negative divergence. We were going up with the S&P as this was going down. This is showing that there's not a lot of strength internally now on a daily basis, as well as we're seeing here on a weekly basis. Just something we need to be aware of. Price is the ultimate indicator, but looking at some of these other indicators can give us some clues as to what's happening. We're also declining, but still above zero with the summation index based on price. Also still above zero, but declining based on volume. This is longer term, and it uses the McClellan oscillators to calculate the summation indexes. So this is showing some weakness now, but longer term, it's still positive. This is the Swenlin trading oscillator. We're coming right back down and dropping slightly below zero based on price. And we're came back up and we're slightly positive based on volume. This is the bullish percent index. And even though I use a daily chart and this is a weekly chart, we're seeing pretty much those same things. This is positive since it's above 50, but we've been chopping sideways. The S&P was going up and we're seeing this just kind of doodle along sideways. We want to see this going higher, and we're just not seeing that right now. It's positive since we're above 50, and it's not breaking down, but this could also be taken as a negative divergence. And then we look at the momentum. The PMO is trying to turn back up and go positive, but we're getting near this red line, which often can mean an extreme reading. Now, we can still go above this, but this is just where we start to really watch this more closely. We're below zero based on price with the momentum, and we're declining, but still above zero based on volume. We're seeing volume still holding up a bit better than we are seeing price right now, even internally. So we do some studies that are connected to the PMO. We declined with the PMOs that are rising. We're going up with the buy signals, and we're flat and barely trying to go back up with the PMOs that are above zero based on the weekly charts. A week ago, we were extreme positive with the percent B. That means that we closed outside of the upper Bollinger Band. Since we were chopping sideways and had a slight down week, we're no longer extreme. This is our momentum, and we have a couple of short-term indicators here trying to turn back up with the slope and TSI. The MACD is trying to turn back up. The PMO is still positive. The PPO is still positive. We haven't quite crossed over positive here with our longer-term oscillators, the TRIX and the KST. The money flow is declining, and this is a smart money indicator, and this is causing us a little bit of concern. It's still positive on the daily chart, but it did decline after Friday's session. This is another smart money indicator. We're coming down with the Chaikin oscillator. The force index, it actually is a little bit negative on the daily charts, where we're coming down, but still positive here on the weekly chart. We're still extreme positive with the money flow, where we're declining, but still positive on the daily chart. The rate of change was down slightly from last week to this week. This is the one that's a little more important, where we go back 50 weeks. We're still above this red line, even though we did decline. There are other times when getting around this red line marks some kind of a top, but there's other times when we can go way above that as well. The RSI is still extreme positive. It's above 70 on the weekly chart and turning down just a little bit. The daily special K chart is still negative on the weekly chart, and we're still positive on the daily chart. The Stochh RSI, we're above the midpoint. We rolled over a little bit, but we're still positive on the weekly chart here. We're still extreme positive with the Williams percent R, even though we did decline slightly. And we're dropping down. We've actually turned negative on the daily chart with the ultimate oscillator. We're coming off of an extreme positive reading on the weekly chart. And we're actually looking a little better here with the weekly chart. The vortex has the green line on top. That's positive. The red line's below. That's positive for the green line. We're declining on the daily chart, but we're starting to go back up here on the weekly chart. The copy curve is still positive and trying to roll back over and turn positive. Where on the daily chart, it's starting to cross over negative. We didn't hit any support levels here, so I really didn't have anything to point out on this chart. We're going back up with our long-term put call, equity put call ratio. When this is going down, that's positive. When this goes back up, that is more negative. But we're still declining here. When we look at the VIX and take a 3-month average of the VIX and do a ratio, this red line going down is typically positive for the market. With our different charts, here's a weekly chart of the Heiken Ashi, still looking really solid there. We're looking solid with the Kigi chart, a black line pointing up. We're also solidly positive with the Renko and the 3-line break. On a trending basis, we're still holding up, and the long-term trend right now is holding up better than the short-term trend, which only stands to reason because it takes longer for these things to change. The ease of movement did decline, but we're still above zero with the 14-week version of that indicator. And we didn't have any new X's or O's drawn in here. We're still looking positive, and we had a double top breakout that was generated on May 13th. This is a point and figure chart. It does not take time into account. If we move enough to the upside, that'll draw in a new X. If we move enough to the downside, that'll draw in a new O. So this is looking more positive. Then we look at a weekly chart of a long-term PPO study, another momentum oscillator. We're still looking okay in the long term. Came down a little bit in the intermediate term, turning a little bit more negative, but still positive nonetheless. I guess you should say we're showing some weakness in the short term. The 50-day cycle started on June 4th, and looks like, so far anyway, this is an uptrend. And then we look at the the Elder's Impulse system. We're still green with the bars. Now, this bar is not all that beautiful looking here. If you can see that, we opened, hit a high, and then came down and closed pretty much at the low. On a weekly chart, that could be a little bit nerve-wracking. It's just something we want to keep an eye on. But we're still positive with the parabolic SAR in the weekly chart. We're also positive on the parabolic SAR daily chart. The concern that I'm seeing on the daily chart is in Friday's session, we came right down to this dot. A lot of people use these as a place to set stop loss orders. And as this goes up, they set what are called trailing stop loss orders, so that if we do completely fall apart, you're not stuck with the same stop loss that you originally set. They actually are canceled and you put in new stop loss orders here. Broad market measures. This is looking at seasonality, where we're starting to end here with June, and then we're going to be shifting over into July, which tends to be a more positive month. Then we look at the S&P on top, which is coming off of recent all-time highs, the mid caps, which are languishing and have not surpassed these previous highs. Yeah, we were up with the small caps, but we've been range bound for all of 2024. When we look at a moving average crossover for the Dow, we are still positive and above the blue line, which is the 13-week moving average. We're positive with the NASDAQ weekly chart, positive with the NASDAQ 100. I was pointing this out in the daily videos a week ago. This was looking kind of scary to open, hit our high, and then come down to the close. And then we saw a down day earlier in the week, and this was really looking scary. Well, now we're seeing a couple of weeks of real indecisiveness here. The mid caps, they're really kind of languishing right now, but they're still in a longer term uptrend. The small caps are below this blue moving average and have been just chopping sideways in 2024. The NYSE, this is a broad market measure. We're still above this 13-week moving average and still in an uptrend. The Wilshire, another broad market index, but this is a daily chart. You can see how we really shot higher right after the open and came down. Now, this didn't close at the low, but it certainly closed near the low on Friday. When we look at all stocks on the weekly chart, we're still looking positive. This is seeing a little bit of a breakout here with the 30 biggest software companies in the US. We have been in danger of seeing a death cross here with the weekly chart, but this was up over 3.5% this past week. The FANG index setting recent all-time highs and still looking pretty good. ARC just not really participating. We're seeing a death cross here on the weekly chart. We've also crossed over negative on the daily chart, even though it was up 1.45% for the week. We're keeping an eye on the banks too to see if more things start to come in. We've been kind of chopping around the last number of weeks here, but we crossed back above 50 with the RSI in the weekly chart. but on a momentum basis, we're turning more negative. This is deposits going into commercial banks where this is continuing to go up, which could suggest some confidence in the banking system. Then this is a weekly chart of Dow theory where we've been going sideways. The Dow was actually more solid over the last week or so, but we're not really breaking out and setting a new all-time high. The transports are just not really performing well, and that's dragging some things down. Utilities had really been shooting up. Now they seem to be going back down. Broad market, we look at the CRB index, a weekly chart, we're still in an uptrend here. Oil did get back above 80. It is starting to go back up now. Copper, which has been coming down, lost another 1.14%. We're still in an uptrend, but we're dropping below, and you can't even see it. It's the blue moving average, which is the shorter term, but we're still above this 50 week. Okay, that's a 200 week moving average. Usually these moving averages are incorrect. We were up just barely, but we're still in an uptrend on the daily chart and here on the weekly chart with the dollar. Gold's been just more or less chopping sideways. It was barely unchanged, but it still has been stronger lately. Silver came back down to this 13-week moving average and is still in an uptrend, even though it fell 1.5% for the week. We keep an eye on the price of bonds where we're still in an uptrend this way. We do still show that on a monthly chart, stocks are still outperforming bonds. We look at the daily chart of the yields where we had been coming down, and then for a lot of the week we were chopping sideways. We saw interest rates going up later in the day on Friday, and that was pressuring stocks that ended up heading lower. This is a weekly chart showing the US, UK rates on top, and then the German rates and Japanese rates, and pretty much all the rates went up on a weekly basis. We look at an intermarket analysis chart showing that oil is still in the lead, followed by stocks, then gold, then the dollar. Bonds are still negative going back to the beginning of 2024. We look at a ratio on a weekly chart between the NASDAQ 100 and the S&P, showing how the NASDAQ 100 is back to outperforming. And they're both doing well, but the NASDAQ 100 is doing even better. The S&P 100 is outperforming the rest of the S&P 500. Growth is still outperforming value. That's what we want to see in a real rising positive environment. And gold compared to the S&P, just not really doing much. We saw enough of a bounce up to generate a golden cross here with this ratio, but since that time, we've been just languishing. And then comparing gold to the dollar on a weekly chart, we did break out above this blue line, but the dollar's been holding up a little bit better as gold has been under a bit of pressure lately and just chopping sideways. When we look at a weekly chart of bonds compared to stocks, this green line going down just means bonds are underperforming based on price when compared to stocks. The low volatility compared to the S&P, this continues to go down, just showing, and these are the stocks that folks get into when the market's turning more defensive. Well, this going down means that the market is not necessarily turning defensive based on this ratio. We look at discretionary. This includes things like Amazon and Tesla, and we want to see this doing a lot better. It is improving, but we saw a recent death cross here with this ratio when compared to staples. Staples are the things that you have to have. Just think toilet paper and toothpaste. And then we look at another ratio between the energy sector compared to tech. Energy has been underperforming, even though we're seeing a little bit of a bounce up lately. Then we look at some long-term secular, which means this can last decades, and cyclical trend studies. Those are things like 2022 was a cyclical bear market within a longer-term secular bull market. So looking at the NYSE breadth thrust, I just show this just to give you an update of where we're at. The trigger was actually signaled back in October of 2022, and we've been bouncing up after that. That was the big buy signal that was generated. This is the ZWAG NYSE breadth thrust, which we almost had one early in May, didn't end up getting triggered here. We're still working off of the previous signal since they last for a year. So this is still on the books and a longer-term positive signal. Then this is saying many mocked this, but it's working yet again. This is looking at the ZWAG NYSE breadth thrust and how it performed 1 month, 3 months, 6 months, and 12 months out. We don't know the actual results yet, but the returns are quite good going forward. This is the Horchak method, another long-term buy or sell signal. It's still on a full-on buy and has been for most of 2024. This is a weekly chart of the S&P going back to the 1987 crash. We're well above this trend line. This is a shorter term look at that same chart going back to 2018. We're well above this trend line for right now. And we look at the NYSE new highs minus the new lows, and then take a 50-period exponential moving average. This is declining, and that's a concern, but it's above zero, so it's still positive. And then this looks at the S&P 500 highs minus the lows. This is also declining, but still above zero. There's a long-term weekly chart of the NASDAQ 100. We're well above the trend line going back to 2009. This is the ratio between the NASDAQ 100 and the Dow. We're actually breaking above recent ratios. We look at the QQQs, which again is the NASDAQ 100, and compare them with small caps. Since the Qs suffered a little bit this past week and the small caps were up, that's why we're seeing this ratio coming down slightly. We look at semiconductors and do a ratio with the Dow. This is also breaking out, even though it has been falling back, as semiconductors have been seeing some profit taking lately. Then we look at the new highs minus the new lows on a cumulative basis for the NASDAQ. This had been declining for years. It was starting to go back up. Now we're going sideways. And we're keeping an eye on the 3-month yield. When this really broke down, that's when we went into the great financial crisis. We're watching this to see if there's some kind of a similar break here, but we're just not seeing it yet. And then the Hindenburg-Omen, that's pretty much is come and gone. If you want to read about it, you can pause it and look at this. We did not get a confirmation signal. Then the 20 trading days were passed after this first spike actually happened. But then when you go ahead over here to the NASDAQ, we're getting all kinds of signals that you can see they're pretty much false signals along the way. The NASDAQ just kept going up anyway. Seasonality, have a number of charts to show you here. We're starting to get near the end of June. Now we're going to be bouncing into July. I'll be shifting this box over. And we're comparing 1982, which we saw a really nice upward move, which led to kind of the beginning of the longer term bull market that we saw. And then this is comparing with what's happening in 2023, now going into 2024, and it's actually outperforming this, even though I don't have anything on this particular chart. I've switched things over to July here when we look at the monthly returns going back to 1950, where July tends to be a pretty strong month. And then we switch over here looking on a world basis. June ended up being negative on a world basis. It looks pretty good when we look at it in July on a monthly basis here. And then looking at June, July, and August, these tend to be well-performing months during an election year. These are some stock traders almanac charts. This is a little bit outdated because we're coming up into the end of June, comparing it to the top first quarter during election years. And that's kind of what we've been mirroring lately. Then this looks at the election year going from 1949 to 2023. When we have some kind of a dip like we saw in April, that typically will mean good things going forward. And we've already finished with June. Now we're going to head into July, where we do see a nice little upthrust seasonally before we see a fallback and then another bit of a pickup at the end of July going into August. Then this is looking at the NASDAQ seasonal patterns, where July tends to see a nice little upthrust and then a bit of a pullback before we start to see more of a solid uptrend going forward. This is comparing 2012 with what's been happening in 2024. This is a bit updated. I haven't been able to see a recent version of this chart since the beginning of May. So we're following mainly this blue line to see if we're going to stick with that basic pattern. This is also looking at June, July, and August based on the 4-year of a presidential cycle. June tends to be okay. July's even better, with August being even better than that. And the conventions are going to be right around, I don't know the actual dates. They're usually at the end of July or beginning of August. And then going back to looking at July, when we go back to 1950, that's the yellow line, it's positive. The past 20 years, that's the blue line, that's positive. The past 10 years have been the strongest. And during an election year, that actually performs the least, but it's still positive. And then this is looking at seasonality from 1976 to 2023. This, at the time I took this, which was a little bit more in the middle of June, we had been really outperforming this part. And then next week, I will switch this box over into July. And then I did change it here, where the first part, or the first half of July, tends to be the strongest part of the year based on this chart. When you look at a median 2-week S&P 500 returns going back to 1950. The second half of July does end up being positive, but not as strong as the first part. And this is a longer term chart saying that we're still in that sweet spot for seasonality from June, July, August, and even September, but there are some downward moves along the way. So thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.